Traders today are bombarded with smart money concepts, claiming to reveal the secrets of big players. But these ideas aren't as new as you might think. These concepts are just a modern remix of the Wyckoff method. The Wyckoff method, developed nearly a century ago, is the original blueprint for understanding smart money trading. This is the video you need to watch if you really want to learn about the inception of smart money concepts. Trading isn't a fair game. It's not you against other small traders. It's you against big players with deep pockets. These big traders have more money, better tools, and access to info you don't have. They know how retail traders think, and they use this to trick small traders like you and me. Here's the reality. The odds aren't in your favor. Wyckoff teaches you to use logic to figure out the market. The big idea is this. When smart money buy or sell, they leave marks on charts. These marks show up in price and volume data. If you know how to read these signs, you can trade along with the pros. You're not their prey anymore. You're on their side. And you're not just guessing anymore. You have a map. The Wyckoff method is built on 3 key laws that explain how markets work. These laws help you see what's really moving prices, not just what's on the surface. Let's start with the law of supply and demand. This law is the engine that drives the market. It's pretty simple. When more people want to buy than sell, prices go up. When more want to sell than buy, prices go down. But it's not just about numbers of buyers and sellers. It's about how much money they're willing to spend. It's about the intensity of their actions. One big buyer can have more impact than many small sellers. The law of supply and demand says that price, volume, and trend all work together. Price shows which way the market is going. Volume shows how strong that move is. When price and volume agree, it confirms the market direction. We'll talk about this later. The law of cause and effect tells us that big moves in the market don't just happen out of nowhere. They need preparation. It's like a rocket launch. Before a rocket can take off, it needs a lot of fuel. In the market, that fuel is buying or selling pressure building up over time. The size of the cause determines the size of the effect. A small cause leads to a small move. A big cause can lead to a big move. This is why Wyckoff traders look for signs of accumulation, which is buying, or distribution, selling. These are the causes that can lead to big price moves. This law helps explain why markets sometimes seem to move for no reason. There's always a reason, but it might have been building up for a while before you noticed it. The law of cause and effect also says that if there's no preparation, there will be no move. This helps you avoid false signals. If you don't see a cause building up, you shouldn't expect a big effect. It's all about preparation. In the market, this often shows up as trading ranges. These are periods where price moves sideways, bouncing between support and resistance levels. To the untrained eye, these might look boring, but to a Wyckoff trader, they're exciting. They're where the cause is building up for the next big move. Lastly, we have the law of effort versus result. This law helps us spot when something's off in the market. It's about comparing the effort, usually measured by volume, with the result, the price movement. Here's how it works. The market is always trying to move one way or the other. These attempts can be short or long. Either way, they represent effort, which we see as volume. If you see a lot of volume, meaning effort, but prices barely move, meaning result, that's a red flag. It might mean the current trend is running out of steam. On the flip side, if prices move a lot on low volume, that move might not last. This law helps you spot divergences. A divergence is when the effort and result don't match up. It's like a warning sign that something might be about to change. The law of effort versus result is like a lie detector for the market. and is especially useful for spotting trend changes. Often before a trend changes, you'll see a mismatch between effort and result. It's like the market is trying hard to keep going in the same direction, but it's running out of steam. The Wyckoff method breaks down market action into 4 main phases: accumulation, markup, distribution, and markdown. Accumulation is the first phase. It happens at market bottoms. This is when big players start buying. They do this quietly, so prices don't go up too fast. During this phase, prices often move sideways. It might look boring, but a lot is happening under the surface. In accumulation, most people are scared to buy. They think prices might keep falling. But smart money sees value. They buy when others are afraid. This phase can last a while. It takes time for big players to buy all they want, without pushing prices up too much. Look for these signs in accumulation. Prices stop falling and move sideways. Volume is low, but picks up on price dips. Price drops don't last long. Strong buying when prices fall a bit. The uptrend or markup phase comes next. This is when prices start to climb. The big players who bought during the first phase are now letting prices rise. They might even buy more, pushing prices higher. In the uptrend, more people start to notice the market. They see prices going up and want to join in. This extra buying helps push prices even higher. Look for these signs in an uptrend. Prices make higher highs and higher lows. Volume often increases as prices rise. Pullbacks are short and shallow. Each new high is met with strong buying. The third phase is distribution. This happens at market tops. Big players who bought low are now selling. They sell slowly, just like they bought slowly. They don't want to crash the market by selling too fast. In distribution, most people are excited. They think prices will keep going up forever. But smart money knows better. They are quietly selling to these eager buyers. Distribution can also take some time. Look for these signs in distribution. Prices stop rising and move sideways. Volume might increase, but price rises don't last. More volatility with sharp ups and downs. Each new high is quickly sold into. The last phase is the downtrend or markdown. This is when prices start to fall. The big players have finished selling. Now there aren't enough buyers to keep prices up. In the downtrend, fear takes over. People who bought high start to panic and sell. This pushes prices down even faster. Like the uptrend, the downtrend often moves in waves. Again, look for these signs in a downtrend. Prices make lower lows and lower highs. Volume often increases as prices fall. Bounces are short and weak. Each new low is met with more selling. These phases don't always happen in a perfect cycle. Markets are messy. Sometimes a phase might be skipped or cut short. Other times, a phase might last longer than expected. The key is to be flexible and watch for the signs of each phase. In accumulation, you start to get ready to buy. You look for signs that big players are accumulating. These signs might include failed attempts to push prices lower or strong buying when prices dip. During the uptrend, the goal is to buy pullbacks. These are temporary dips in an overall rising market. You wait for the uptrend to be confirmed before buying. You don't try to guess the bottom. In distribution, you start to get cautious. You might take profits on long positions. You watch for signs that the uptrend is weakening. These signs could include failed attempts to make new highs or increased selling at high prices. During the downtrend, the goal is to sell short. Most of the money in a trend is made in phase 2, the uptrend, and phase 4, the downtrend. The transition phases, accumulation and distribution, are often trickier to trade. They are more about preparing for the next trend. One key skill in using the Wyckoff method is identifying changes in market character. This is when the market shifts from one phase to another. For example, the shift from accumulation to uptrend or from distribution to downtrend. These changes often happen gradually. The market doesn't suddenly switch from one phase to another. Instead, it transitions slowly. Another important aspect of the Wyckoff method is understanding the concept of supply and demand. In accumulation, demand is slowly overcoming supply. In distribution, supply is slowly overcoming demand. The uptrend and downtrend are when these forces play out. Volume plays a crucial role in identifying these phases. In accumulation, volume often increases on price dips. In distribution, volume often increases on price rises. Another key point, in both accumulation and distribution, big players are trying to hide what they're doing. They don't want everyone to know they're buying or selling big amounts. That's because they would move prices before they're ready. This is where the idea of smart money comes in. These are the big, well-informed players, and they're always trying to stay ahead of the uninformed traders. Remember this, accumulation and distribution are about more than just buying and selling. They're about the transfer of risk. In accumulation, smart money is taking on risk, betting that prices will go up. In distribution, they are passing that risk to others, to less informed traders. And one more thing to remember, emotions play a big role in these cycles. In accumulation, fear is the main emotion. People are scared to buy because prices have been falling. In distribution, it's often greed and fear of missing out. People buy because they're afraid of missing the next big move up. Now, before we continue, let us know in the comments what topics you'd like us to cover. Tell us what you want to watch next. Now let's break down Wyckoff events. They're like clues that help us figure out what's really going on in the market. First, we have the preliminary support. This is when big players start to buy, trying to stop prices from falling more. It's like putting a floor under the market. You might see prices stop dropping as fast, or even bounce a little. Next comes the selling climax. This is a big moment. It's when scared sellers dump their positions. Prices often fall hard and fast, but the big players are buying during this panic. They're getting ready for prices to go up later. After the selling climax, we see an automatic rally. Prices bounce up a bit. This happens because the selling pressure eases off. It's like the market taking a breath after all that selling. Then we have the secondary test. Prices fall again, but not as low as before. This is important. It shows that the big drop might be over. Big players are still buying, keeping prices from falling too far. Now we come to the spring. This is a tricky move. Prices dip below the low point of the secondary test. It looks like the market might fall more, but it's often a fake out. Prices quickly jump back up. This is a key sign that big players are done buying and are ready for prices to go up. After the spring, we see a sign of strength. This is a strong move up, often with lots of trading. It's like the market saying, we're ready to go up now. And then we have the last point of support. This is one more dip before the real uptrend starts. It's like the market taking one last breath before climbing. These events don't always happen in this exact order. Markets are tricky and always changing, but knowing these events helps you see the big picture. If you see signs of accumulation, like the preliminary support or spring, it might be a good time to think about buying. If you see signs of distribution, like a buying climax or sign of weakness, it might be time to be careful or even think about selling. The end of an accumulation phase, like after a successful spring, can be a great time to buy. The end of a distribution phase can be a good time to sell. But remember, you don't need to catch the exact bottom or top. What matters is catching the main move. And don't get too hung up on naming each event. What's more important is understanding what these events mean. They are showing you the transfer of risk in the market. Like I said before, in accumulation, smart money is taking on risk, betting prices will go up. In distribution, they are passing that risk to others. Volume is a key part of the Wyckoff method. It helps confirm what price is telling us. The main idea is simple. Volume should match price moves. If prices go up, volume should too. If prices fall, volume should rise. When volume and price don't match, it can mean trouble. Wyckoff saw the market as a fight between buyers and sellers. Volume shows who's winning. High volume on up moves means buyers are strong. High volume on down moves means sellers are in control. We talked before about Wyckoff's law of effort versus result. This law says the effect of a price move should match the effort behind it. The effort is shown by volume. The result is the price change. Here's how it works. Big volume, the effort, should lead to big price moves, the result. Small volume should lead to small price moves. If there's a mismatch, it can signal a change coming. High volume with little price change often means accumulation or distribution. Low volume with big price moves usually isn't sustainable. Rising prices with falling volume can mean the uptrend is weakening. Volume helps confirm price action. It's like a lie detector for price moves. Price alone can sometimes lie, but price and volume together usually tell the truth. In accumulation, watch for high volume on down days that don't push prices much lower. This can mean big players are buying, soaking up the supply. It's a sign the downtrend might be ending. In distribution, look for high volume on up days that don't push prices much higher. This often means big players are selling into strength. It's a sign the uptrend might be ending. During trends, volume should generally increase in the direction of the trend. In an uptrend, volume should be higher on up days. In a downtrend, volume should be higher on down days. But it's not just about whether volume is high or low. The spread, the body of the price bar, matters too. Wyckoff and later traders like Tom Williams saw the relationship between volume and spread. Here's what to look for. Wide spread and high volume. This means usually bullish. Wide spread and high volume. This means usually bearish. Narrow spread and low volume often means consolidation. One common pattern is a climax. This is a day with very high volume and a wide price range. It often marks the end of a move. In a downtrend, it might be a selling climax, marking the end of the drop. In an uptrend, it could be a buying climax, signaling the end of the rise. After a climax, watch for a test. This is when prices return to near the climax level, but on lower volume. If the test holds, it can confirm the end of the old trend and the start of a new one. Volume can also help spot manipulation. If you see a big price move on low volume, be suspicious. It might be a false move designed to trick traders. We'll talk about this later. Real sustainable moves usually come with solid volume. In the Wyckoff method, volume isn't just about quantity, it's about quality too. A day with steady buying is different from a day where all the volume comes in one big spike. Learn to read the quality of volume, not just the quantity. One key skill is spotting divergences between price and volume. If prices are making new highs, but volume is dropping, it can mean the uptrend is weakening. If prices are making new lows, but volume is drying up, the downtrend might be running out of steam. Volume patterns can also hint at what's coming. For example, expanding volume as prices move sideways often precedes a breakout. The direction of the breakout isn't certain, but the increase in volume suggests something big is cooking. In accumulation, you might see a series of high volume down days that fail to push prices lower. This is often followed by an upward surge on even higher volume. This pattern can signal the end of this phase and the start of markup. In distribution, you might see a series of high-volume up days that fail to push prices higher. This is often followed by a downward plunge on even higher volume. This pattern can signal the end of distribution and the start of markdown. Volume can also help with timing. In a strong trend, wait for a pullback on lower volume before entering. This often provides a good entry point with lower risk. And one final point about this, volume often leads price. You might see volume patterns change before price patterns do. This can give you an early warning of potential trend changes. Wyckoff talked about the composite operator in his books. This isn't one person. It's a way to think about all the big players as if they were one. These big players include banks, hedge funds, and other pros, and they often act in similar ways. They're all trying to make money, and they have more info and power than regular traders. The composite man isn't real. It's a tool to help us understand the market. It's like pretending the market has a mind of its own, and this mind is smart and sometimes tricky. Here's what the composite man does. He buys when prices are low. He sells when prices are high. He acts in its own interest, and he knows how to move prices. The composite man doesn't control the whole market, but it has a big impact. It can push prices up or down for a while. The composite man concept helps explain why markets often move in ways that seem odd. Why does price drop right before a good news release? The composite man might be selling into the excitement. Why does a market sometimes go up on bad news? The composite man might have already sold. The bad news was expected. Now it's buying again at lower prices. Trading with the trend is key. If the composite man is pushing price up, don't try to short. You'll probably lose. Go with the flow. Again, always check volume. It's the footprint of the composite man. Big volume moves are often important. The composite man links to other Wyckoff ideas. Springs and upthrusts are often the work of the composite man. We'll talk about these in a minute. This concept also explains why stop hunting happens. The composite man knows where stops are likely to be. It can push price to hit those stops. Then it trades against the stop orders. You'll soon realize that many price moves aren't random. They're often planned. The spring and the upthrust are key patterns in the Wyckoff method. A spring is a quick drop below support that bounces back fast. An upthrust is a quick push above resistance that fails fast. Both are fake-outs that run stops outside support and resistance. Smart money concepts renamed them as liquidity sweeps or liquidity runs. Why do they happen? Because big players often push price past key levels to trigger stop losses. This lets them buy or sell at better prices. It is like shaking a tree to make the fruit fall. Let's look at springs first. In a trading range, price might dip below support. If it jumps back up fast, that's a spring. It means there's strong buying down there. It often leads to a move up. Here's how to spot a spring. Price is in a range. It breaks below support. It doesn't stay there long. Then it jumps back above support fast. Upthrusts are the opposite. Price pops above resistance, but falls back quickly. It shows there's strong selling up there. It often leads to a move down. Here's how to spot an upthrust. Price is in a range. It breaks above resistance. It doesn't stay there long. Then it drops back below resistance fast. Both patterns show a fight between buyers and sellers. In a spring, sellers try to push price down, but buyers win. In an upthrust, buyers try to push price up, but sellers win. For a spring, the plan is to buy when price jumps back above support. For an upthrust, You sell when price drops back below resistance. But it's not always that easy. You need to look at the bigger picture too. For springs, check if the overall trend is up. A spring in an uptrend is stronger than one in a downtrend. Look for signs of accumulation before the spring. This makes the pattern more likely to work. For upthrusts, check if the overall trend is down. An upthrust in a downtrend is stronger than one in an uptrend. Look for signs of distribution before the upthrust. This makes the pattern more likely to work. Volume is key in these patterns. In a spring, you want to see high volume on the drop, and even higher volume on the bounce. This shows strong buying. In an upthrust, you want high volume on the push-up, and even higher on the drop. This shows strong selling. Some traders do well without focusing on volume. The price action itself can be enough. The context matters a lot. A spring or upthrust at the end of a long trend is more powerful than one in the middle of a range. It might signal a big trend change. One trick is to look for smaller ranges near the edge of bigger ranges. These often lead to good breakouts. You might see springs or upthrusts in these smaller ranges before a big move. Sometimes you won't see a spring or upthrust at all. This is called a structural failure. It happens when price fails to reach one side of a range and then breaks out the other way. This can be a strong signal too. One way to practice is to look for these patterns after the fact. Go through old charts, mark the springs and upthrusts, see what happened after. This trains your eye to spot them in real time. Now let's dive into some advanced Wyckoff concepts. One advanced concept is the creek. This is a small, tight trading range that forms after a big move. It's like a pause in the action, but it's not random. It often shows up at the key points in trends. Creeks can be hard to spot if you're not looking for them. They might look like normal price action, but they can signal big moves ahead. Here's how to use creeks. Look for them after strong trends. Check if volume dries up in the creek. Watch for a strong move out of the creek. If you see these things, it might be a good trade setup. The move out of the creek often starts a new trend. Another advanced concept is the idea of tests. These are like mini versions of springs and upthrusts. They happen all the time, not just at major turning points. A test is when price moves back to a previous support or resistance level. It's checking if that level still holds. If it does, it can be a good entry point for a trade. Tests are powerful because they show real supply and demand in action. They're not just lines on a chart. They show where real buying and selling is happening. Here's a pro tip. Look for tests that fail. If price tests a level and breaks through, that can signal a big move. It means the previous support or resistance isn't working anymore. Another advanced idea is absorption. This is when big players buy or sell without moving price much. It's hard to spot, but it's a powerful signal. Absorption often shows up as high volume, but little price movement. It might look boring on a chart, but it can signal that a big move is coming. Wyckoff traders always think about context. They don't just look at patterns. They think about where those patterns fit in the bigger picture. For example, a spring in an uptrend is different from a spring in a downtrend. A test of support after a long uptrend is different from a test early in a trend. Another advanced idea or losing strength. In an uptrend, you want to see higher highs and higher lows. But how much higher? Swing analysis helping. Another advanced idea is the fractal analysis. This is about understanding